Listen up. This is not your stock price. This is not your credit card interest rate. And this is damn sure not some random Wall Street headline that doesn't affect you. This is the pressure gauge inside the single most important market on the entire planet, the US Treasury bond market. And right now, that gauge is flashing a very specific number. No, it's not the 10-year Treasury at 5.2%. That number is bullshit. People keep repeating. The 10-year is sitting around 4.6%. The real warning is further out on the curve. The 30-year long bond, that sucker has been trading around 5.1% and just spiked as high as roughly 5.18%. Highest level since before the global financial crisis. Yeah, that one. And that difference matters. Because if you screw up the number, everyone rolls their eyes and says, whatever day. But if you get it right, suddenly the warning is a lot harder to laugh off. Look, I'm not here to tell you America is collapsing tomorrow. I'm not saying we're about to default next week, and I'm definitely not telling you to go sell everything and hide in a bunker. But this is a serious fiscal warning. The bond market is basically looking the United States in the eye and saying, hey, if you want to keep borrowing money for the next 30 years, you're going to have to pay us a hell of a lot more to take that deal. Higher long-term yields mean higher mortgage rates, higher interest payments, more pain for banks, more pain for your retirement account, and way more pain for the federal budget. And guess what? This pressure isn't some future theory anymore. It's already showing up in the mortgage quote you just got, in your bond fund statement, on your bank's balance sheet, and in the government's monthly interest bill. Stick with me till the end of this video and you'll finally understand why a 30-year Treasury yield flirting with 5.2% is not just another boring Wall Street number. It's a giant yellow warning sticker slapped right on the entire American financial machine. Let's rewind for a second. You can't get why this matters until you understand what a Treasury bond actually is. Here it is in plain, no bullshit English. A Treasury bond is just a fancy IOU. The US government needs cash to pay the military, Social Security, Medicare, interest on old debt, you name it. So it prints these bonds and sells them to investors. You give them money today, they promise to give it back later, plus interest. For decades, that IOU was treated like the safest thing on earth. Not because America has zero problems, we've got plenty. But because we have the world's reserve currency, the deepest markets, and a pretty damn good history of actually paying our bills on time, that's why everybody owns these things. Foreign governments, central banks, pension funds, insurance companies, banks, your grandma's target date retirement fund. Hell, every single mortgage, car loan, and corporate bond in the economy is priced off the Treasury market. This isn't just another market, this is the damn foundation of the whole financial system. Now let's talk about the two numbers that actually matter today. First, the 10-year Treasury yield. That's the rate investors want to lend the government money for 10 years. Right now, it's hanging around 4.57%, maybe 4.6%. Sure, but not the 5.2% everyone's screaming about. Second, and this is the one you need to pay attention to, the 30-year Treasury yield, the long bond, the price of lending, Uncle Sam money for 3 freaking decades. That rate has been hovering around 5.1% and just hit about 5.18%. That is the signal. Not because 5.2% means the sky is falling tomorrow, but because the long end of the curve is where investors put their real long-term fears, inflation, debt, fiscal stupidity, into actual dollars. Think of the 10-year as the patient's heartbeat. Think of the 30-year as the full stress test on a treadmill. When the long bond starts creeping toward 5.2%, the market is quietly telling you, we're going to need a lot more compensation if we're going to hold this debt for an entire generation. That message is slower, colder, more mathematical, and honestly, way more dangerous than some screaming headline. So why the hell do yields even go up in the first place? Simple. Bond prices and yields are like a seesaw. When investors say, nah, I need a higher return before I buy this, the price drops and the yield shoots up. That's it. Long-term Treasury yields climbing means investors are demanding more pay to take on long-term US interest rate risk. Could be inflation fears. They think tomorrow's dollar is going to buy less, so they want more interest today. Could be Fed uncertainty. If they think short-term rates are staying higher, longer, the long end moves too. Could be simple supply. The government is dumping a mountain of new bonds on the market every month. Or, and this is the one that should actually worry you, it could be pure fiscal pressure. If deficits keep exploding and the debt keeps piling up, investors start saying, you know what? We want a higher term premium for this circus. That last reason, that's the real warning. It doesn't mean the market thinks America is defaulting next Tuesday. We still borrow in our own currency. We still have the deepest markets on earth. Treasuries are still the king of safe assets. But the free lunch is getting more expensive. For years, we could borrow at ridiculously low rates. Investors treated US debt like financial oxygen, boring, safe, always there when you need it. That golden era, it's ending. Not overnight, but it's ending. And when your debt is already this stupidly large, the math turns ugly real fast. Right now, the United States is sitting on roughly $39 trillion in total federal debt. Let that sink in. Spread it across every man, woman, and child in the country. That's over $115,000 per person. Nobody's mailing you a bill tomorrow, but every single taxpayer is living inside the system that has to pay interest on that pile. And paying interest is exactly where the pain starts. In fiscal year 2025, the federal government shelled out about $970 billion in interest, nearly $1 trillion. Not for new roads, not for schools, not for factories, just interest on money we already spent. Interest is now one of the biggest single line items in the entire federal budget. Bigger than defense in some comparisons, bigger than Medicare in some comparisons. Only Social Security is still larger. And higher long-term yields mean that interest bill is going to keep growing. Here's how the debt spiral works. And yes, it is a spiral. Government runs a deficit, borrows to cover it, old debt matures, they roll it over at the new higher rate, interest bill explodes, bigger deficit, more borrowing, higher yields. Rinse and repeat. It's not an immediate collapse, it's a slow, painful squeeze. And squeezes are the worst kind of problem because you can pretend they don't exist until suddenly they're everywhere. So who the hell is still buying all these new bonds? For decades, the answer was easy. Foreign investors. Japan, China, UK, oil countries, central banks, they parked trillions in treasuries because they were liquid, trusted, and basically the world's savings account. That story is changing, but not in the dumb internet cartoon version you keep seeing. Foreigners have not all run for the hills. As of March 2026, they still own more than $9 trillion of US treasuries. Japan is still the biggest holder at about $1.19 trillion. China has cut way back down to roughly $652 billion, lowest since 2008. The UK actually increased to about $927 billion. So the real story isn't foreigners are gone. The real story is some of the old reliable buyers are getting twitchy, and the Treasury still has to sell a mountain of new debt at these higher yields. That's a serious warning. It doesn't need any extra drama. Now, let's bring this straight into your living room, because these yields don't stay on some Bloomberg screen. Your mortgage feels it first. The 30-year fixed mortgage rate isn't exactly the 10-year Treasury, but it dances right next to it. Lenders slap on a spread for risk and profit. As of late May 2026, the national average is sitting at about 6.51%, not 7.5%. That's the real number, but here's why it still bites. Take a $400,000 mortgage. At 6.51%, your monthly payment is roughly $2,531 before taxes and insurance. At 6%, it would be about $2,398. At 7.5%, it jumps to $2,797. That $399 a month difference between 6% and 7.5% adds up to more than $143,000 over 30 years. So yeah, your kitchen table already feels the bond market. Your retirement account feels it too. Everybody got sold the story that bonds are the safe part of your portfolio, and they usually are. Until yields rip higher, then the price of your existing bonds gets crushed. The longer the bond, the harder it gets crushed. Remember, 2022, a lot of bond funds got absolutely hammered. Some have clawed back some of those losses. So I'm not saying every retiree is still down 20%. But if you own long-duration bond funds, rising yields can still hand you real paper losses, even in the safe part of your money. Your bank feels it. Regional banks got a brutal lesson in 2023. Rates went up, the value of their old low-yield bonds went down. If they had to sell to meet withdrawals, ouch. A 30-year yield near 5.2% doesn't automatically blow up every bank, but it does keep the pressure on any balance sheet stuffed with long bonds. And your government? Oh man, they feel it most of all. Every single percentage point higher in borrowing costs doesn't hit the whole $39 trillion pile at once. They don't refinance everything tomorrow. But as old debt rolls over, higher rates slowly bleed into the interest bill. Long-term rates are tomorrow's budget math. Now let's follow the money trail a little deeper. Some hedge funds and big bond traders have been positioned for higher yields for the last couple years. When prices fall, they make money. Good for them. But don't pretend every short treasury trade is some evil plot against America. Sophisticated players just profit from the volatility that leaves normal people scratching their heads. Central banks. They've been buying gold like it's going out of style. 2025 was still historically high buying, even if the pace cooled a bit. That's not the dollar is dead tomorrow. But it sure as hell shows they want a little diversification when the US fiscal picture looks shaky. BRICS countries are playing around with local currency deals and digital payment links. Some trade is settling outside the dollar now. But let's not kid ourselves. There is no 11-nation BRICS system that has replaced the dollar or killed SWIFT. The trend is real, but it's slow and partial. The warning is quieter. The more alternatives they build, the less automatic future demand for dollars becomes. Banks, insurers, pensions, asset managers, they're all trying to manage interest rate risk in a world where zero rates are gone forever. That's not a conspiracy, that's just smart risk management. So where does this all end? Nobody knows the exact breaking point. Anyone who gives you a precise crash date is selling you something. But there are levels worth watching. If the 30-year keeps climbing above 5.2%, long-term borrowing gets more expensive. If mortgage rates push towards 6.5% or higher, housing gets even uglier. If we see long rates approaching 6%, the fiscal pressure becomes impossible to ignore. This is how real financial stress usually starts. Not with a bang, but with years of the bond market whispering warnings that politicians pretend not to hear. The 30-year Treasury near 5.2% isn't a headline to memorize, it's a question you should be asking. Can we really keep borrowing this much at these rates without making some painful choices? Can families keep swallowing 6.5% plus mortgage rates? Can banks and bond funds handle higher for longer without another round of stress? Can the world keep absorbing trillions in new supply without demanding even higher yields? Those aren't doomsday questions, those are grown-up questions. And grown-ups don't need panic, they need clear numbers. So here they are, plain and simple. 10-year Treasury, around 4.6%. 30-year Treasury, around 5.1%. Recently hit 5.18%. Average 30-year mortgage rate, about 6.51%. Total federal debt, roughly $39 trillion. Annual interest cost, close to $1 trillion. Foreign holdings, still over $9 trillion. Japan, biggest at one point, won $9 trillion. China, down to $652 billion. UK, at $927 billion. Central banks still buying gold at high levels. BRICS experimenting, but dollar system still standing. This is the real story. Not the end of America, not the death of the dollar tomorrow, not a guaranteed crash, just a serious fiscal pressure warning hiding in plain sight. If you own a home, have a retirement account, work at a bank, pay taxes, or plan to borrow money in the next 10 years, this market is already talking directly to you. The bond market isn't screaming that the United States is finished. It's warning us that the era of stupidly cheap money is over, and the bill for that party is arriving. One refinancing at a time, don't ignore the signal, but don't exaggerate it either. Follow the yield, follow the debt, follow the interest bill, because the next chapter of this economy might not be written in the stock market, it might be written in the bond market first.